A World Bank and PWC report shows medium-sized businesses globally are becoming less burdened by tax. The Paying Tax study says 78% of the 189 countries surveyed had made significant changes to their tax regimes at least once in the past 10 years. Now, in South Africa, the total tax rate declined from 30.1% last year to 28.8% this year.
The South African tax system ranks favourably in global rankings. It's ranked 19 out of the 189 countries surveyed. However, when it comes to the sub-index of the total tax rate levied, it does less well, coming in 40th out of 189.
How can it reduce the tax burden for companies? And particularly what we're talking about there is reducing corporate income taxes. Can it reduce corporate income taxes to make South Africa more attractive from an economic growth point of view, or make our tax system more attractive from an economic growth point of view?
Mandy suggests one way is for government to shake up the tax regime, placing a lesser direct tax burden on corporates with more emphasis on indirect taxes like VAT. But politically, in the South African context, this has little appeal, as increased VAT would have a harsher impact on the pockets of poorer members of society.
It is particularly unattractive from the point of view of Labour. They are absolutely opposed to seeing increases in VAT. That said, I think if it is done correctly or properly, I think there is an opportunity to shift taxes away from direct taxes to indirect taxes and VAT in particular.
Mandy suggests that social security reforms would need to go hand in hand with any increases in VAT, which would mean raising the cash value of social grants so as to alleviate the regressive burden this tax would have on social grant recipients. The main rationale behind lower taxes on corporates is that they would then have more cash available to invest in their businesses and ultimately the economy, creating much needed jobs. Nompumelelo Siziba, SABC News, Johannesburg.